This week, a measly $280 million fundamentally broke a $7 trillion market.
Yeah, it's a phenomenal example of asymmetric risk.
Right, because that is the equivalent of a single raindrop causing a Category 5 hurricane. Today, we're looking at how a tiny crack in the Japanese bond market just triggered this cascading dislocation that is actively wiping out billions of dollars in U.S. tech wealth.
Exactly. We have spent years watching central banks pump liquidity into the system, right? Creating these massive, completely interconnected financial structures. And what we are witnessing right now is the sudden violent unwinding of that architecture.
Driven by mechanics that most retail investors simply do not see until the damage is already done.
Right, until they check their accounts and panic.
Welcome to today's deep dive. We are untangling a dramatic, fast-moving web of global market shocks that have left investors worldwide reeling. Our theme today is global volatility, AI reality checks, and central bank moves.
Which is a lot to unpack.
It is, but the core mystery we're trying to solve here is this: what do historic circuit-breaking market crashes in South Korea and Japan reveal about the hidden vulnerabilities and really the ultimate trajectory of the U.S. stock market?
Because the stakes here extend far beyond just, academic economic theory. We are talking about a fundamental regime change in the global cost of capital.
It's like a massive game of Jenga. For a long time, the pieces at the bottom, like Japanese interest rates, were completely stable, just totally locked in.
Right, the era of zero interest rate policy.
Exactly. It acted as the gravitational pull for global markets over the last 2 decades. But now, someone is pulling those bottom pieces out, and we need to see how much the top, meaning the U.S. tech market, is going to wobble.
And it is wobbling.
It is. So whether you are a professional managing a massive institutional portfolio or you're just someone logging into your retirement account in Ohio trying to figure out why your balance took a brutal hit this week, you need to understand the mechanics of what is happening here.
They have to know the why.
Right. We are going to arm you with the why and the how behind all these terrifying headlines. And we need to start in Asia because that is ground zero for the current tremors. Let's look at South Korea first. The KOSPI index, which was just the absolute darling of the Asian markets earlier this year, it just suffered a massive capitulation event.
The price action was historically severe. The KOSPI crashed by 11 to 12% in a single trading session.
Just a total bloodbath.
Yeah. To put that in context for a broad market index, that is a generational liquidation.
Yeah.
And if we zoom out just slightly, that plunge brings the total decline to an astonishing 43% from its peak.
Wow.
Right. From 9,386 back in June, dropping all the way down into the 5,311 range in the span of just a few weeks.
That is a violent thrust deep into technical bear market territory.
Very violent.
It was so aggressive that it actually triggered 20-minute back-to-back circuit breakers.
Which is incredibly rare.
Yeah, and for anyone unfamiliar with the physical mechanics of an exchange, a circuit breaker is essentially the stock market's emergency brake. When prices fall too fast, usually crossing these predetermined percentage thresholds, the exchange algorithms literally halt all trading.
They just pull the plug for a minute.
Exactly. The idea is to force human beings to take a breath, stop the panic selling, and allow buyers to step back in. But the trigger for this specific crash is the real story here, I think. It wasn't a bank failure. It was the semiconductor giant SK Hynix.
Right, and SK Hynix occupies a highly, highly strategic node in the global artificial intelligence supply chain.
They make the memory chips, right?
Exactly. They are a premier manufacturer of high bandwidth memory, or HBM chips. These are the specialized memory components that are absolutely essential for running advanced AI processors.
Like the ones designed by NVIDIA.
Exactly like those. Without HBM, the entire AI hardware narrative just grinds to a halt. You can't do it.
So SK Hynix releases their quarterly earnings, and they didn't just have a good quarter, they reported a 6-fold earnings jump.
A 600% increase.
A 600% increase. Now, a significant portion of that was driven by a $44 billion asset value gain, but still the fundamental business is printing money.
Hand over fist.
Right. So in any normal market environment, you would expect the stock to soar. Instead, the stock plummeted over 14% in a single day, and it dragged Samsung down 10% right alongside it.
Yep.
How does a company report a 600% earnings jump and get absolutely punished by the market?
Well, this is where we have to separate the company's fundamental performance from the market's psychological positioning.
Okay, unpack that.
In the current AI hype cycle, incredible, historically strong earnings are just no longer sufficient. The market had priced in what institutional analysts short-term, hyper-elevated estimates.
Hyper-elevated.
Right. Investors were not simply pricing in robust growth. They were pricing in flawless, exponential, uninterrupted acceleration. So when SK Hynix delivered numbers that were merely, fantastic rather than mathematically impossible.
A narrative snapped.
Exactly. The narrative broke.
It reminds me of the psychology behind an impossibly high-stakes dating app profile.
Oh, I like that.
Yeah, like the market swiped right on the AI sector, expecting absolute unblemished perfection based on all these years of hype. And the company shows up to the date, they're highly successful, wearing a bespoke suit, boasting a 600% earnings jump.
Right, they look great on paper.
But because they don't literally own a private island like the profile subtly implied, the market just gets up, throws a glass of water in their face, and walks out of the restaurant.
That is exactly it. We're seeing a market where anything less than absolute perfection is treated as a fundamental failure.
It's perfection or bust.
It is. But the psychology of perfection is, well, it's a great way to frame it, but we also need to look at how that psychological disappointment was mechanically weaponized.
Weaponized by the leverage.
Right, by the leverage in the South Korean market. The 14% drop in SK Hynix was the spark, but retail leverage was the gasoline that turned it into a 43% index-wide inferno.
Let's talk about the mechanics of that leverage, because it's wild. Retail investors in South Korea have been uniquely heavily exposed to single-stock 2x leveraged ETFs. Explain exactly how these instruments work and why they're just so dangerous when the momentum turns.
Sure. So a standard exchange traded fund, an ETF, simply tracks the price of an asset or an index.
Yeah.
If the asset goes up 1%, the ETF goes up 1%. It's 1-to-1. But a 2x leveraged single stock ETF uses financial derivatives and debt to amplify the daily returns of one specific company.
So they're juicing the returns.
Exactly. If you buy a 2x SK Hynix ETF, you're essentially borrowing money to double your exposure. If SK Hynix goes up 1%, your ETF goes up 2%.
Which sounds great when things are going up, but the blade cuts both ways.
Far more viciously on the way down, actually, because of how the daily rebalancing of these funds erodes capital.
Yeah, the math gets ugly fast.
It really does. When SK Hynix fell 14% on its underlying shares, the mathematics of the derivative contracts meant that one of these specific leveraged ETFs tracking it dropped an astonishing 48% in a single day.
Nearly half of your entire principal investment completely wiped out between breakfast and lunch.
Gone.
And that triggers the margin calls, which is where this spreads from a semiconductor problem to a whole market problem.
Precisely. Because when retail traders use margin accounts to buy these highly volatile products, they have to maintain a certain percentage of equity in their account.
A buffer, essentially.
Right. And if a leveraged ETF drops 48%, their account equity just collapses below the broker's minimum requirement. So the broker issues a margin call, demanding the investor deposit more cash immediately.
And if they don't have the cash lying around,
then the broker's automated risk management algorithms step in and forcefully liquidate the investor's portfolio to cover the debt.
And the algorithm doesn't care what it sells.
Not at all.
It will sell your perfectly healthy, dividend-paying consumer goods stocks, your bank stocks, your automotive stocks, just to raise the cash to cover your massive losses in that one AI chip ETF.
And that is the definition of a forced deleveraging cascade. The selling pressure becomes entirely decoupled from corporate fundamentals.
People aren't selling because they think the broader economy is bad.
No, they are selling because their broker is liquidating their account, period.
Yeah.
That is why the entire KOSPI index was dragged down so violently.
And it got so severe that the South Korean financial regulators actually had to step in, right? With emergency interventions.
They had no choice.
They announced regulatory caps limiting these single-stock leveraged products to a maximum of 20% of a retail investor's total assets.
Which tells you how bad it got. They recognized that the market structure had basically morphed into a casino, and they had to forcefully dial down the leverage to stop the contagion.
But as crazy as the South Korean situation is, the regulatory intervention in Seoul kind of pales in comparison to the structural earthquake happening across the Sea of Japan.
Oh, absolutely. If South Korea is experiencing an acute equity market panic driven by retail leverage, Japan is experiencing a systemic bond market panic driven by central bank policy.
And the global implications of the Japanese situation are vastly more profound.
Exponentially more profound.
Let's transition to Tokyo then. We are looking at an unprecedented sell-off in Japanese government bonds, or JGBs. This is a $7 trillion sovereign debt market.
It's massive.
And the yield on 30-year JGBs surged 25 basis points in a matter of days, and the 40-year rates actually topped 4%.
Which is wild.
Yeah, it's a psychological and mathematical threshold we haven't seen since that specific maturity was introduced back in 2007.
Right. And to a casual observer, a 25 basis point move, which is just 1/4 of 1%, might sound like a rounding error.
Sure, I mean, in the U.S. Treasury market, yields can move 10 or 15 basis points on a random Tuesday just based on an inflation print.
Exactly. But in Japan, where yields have been artificially pinned to the floor at 0 or even negative for decades through aggressive central bank intervention, a 25 basis point surge is a seismic shock.
It changes everything.
It fundamentally alters the valuation models for every single financial institution in the country.
Okay, we need to pull back the curtain on the Bank of Japan, the BOJ, and the specific policy decision that triggered this bond market collapse. At their July monetary policy meeting, the BOJ Policy Board voted 7-1 to hike their policy interest rate.
Right.
But the language they use in the sources is incredibly dense. They state they adjusted their guideline for money market operations to, quote, encourage the uncollateralized overnight call rate to remain at around 1.0%. They also set the interest rate applied to their complementary deposit facility at 1.0%.
A mouthful.
Let's stop right there and translate. What is an uncollateralized overnight call rate in plain English?
Sure. It is basically the foundation of the Japanese banking system's daily liquidity. You see, banks are required to hold a certain amount of cash in reserve. At the end of every business day, some banks have excess cash and some banks are short.
They need to balance the books.
Right. The overnight call market is where banks lend cash to each other just for one night to meet those reserve requirements. Uncollateralized simply means they aren't posting bonds or other assets as security for the loan.
So they are lending based on pure trust between the institutions.
Exactly. So by encouraging that specific rate to move to 1%, the BOJ is essentially saying the foundational cost of money for banks to operate on a daily basis is now 1%.
Got it. And the complementary deposit facility rate of 1%.
That means that if a bank simply parks its excess cash directly at the Bank of Japan, the central bank will pay them 1% interest.
Ah, so this effectively sets a hard floor.
Exactly. No bank is going to lend money to another bank for 0.5% if they can get a guaranteed risk-free 1% just by leaving it at the BOJ.
That makes total sense. Now, we should note that 7-1 vote was not unanimous. The lone dissenter was Asada Toichiro.
Right.
He argued that downside risks to production and employment from the geopolitical situation in the Middle East actually outweighed the upside inflation risks in Japan.
Which is a valid concern, honestly.
Yeah, but the majority clearly sees underlying CPI inflation approaching their 2% target on a sustainable basis, and they are finally, after 2 decades, normalizing policy. But here is where the monetary mechanics collide head-on with fiscal reality.
The politics.
The politics. Prime Minister Sanai Takaichi has called for a snap election on February 8th.
Yes. And we are seeing a textbook collision between monetary policy and fiscal policy here.
Now, keeping our analysis strictly neutral regarding the politics itself, the economic reality is that PM Takaichi is navigating a challenging domestic environment.
Very challenging. Inflation, which is driven partly by historically weak yen, makes importing food and energy incredibly expensive.
Right. Japan imports almost all its energy.
Exactly. So that is heavily pressuring Japanese consumers. Her proposed solution to this is aggressive fiscal stimulus.
Meaning massive government spending programs.
Right. Programs designed to boost the economy, subsidize energy costs, and provide direct relief to households.
But the mechanics of government spending require the issuance of new debt. If the Japanese government wants to stimulate the economy, the Ministry of Finance has to issue billions of dollars worth of new Japanese government bonds.
And that is the exact source of the market panic. PM Takaichi is stepping heavily on the fiscal gas pedal, demanding the market absorb a massive new supply of government bonds.
While the Bank of Japan is doing what?
Stepping on the monetary brakes. They are raising rates and signaling a reduction in their own bond buying programs.
So you have a massive influx of new bonds hitting the market right at the exact moment. The biggest historical buyer of those bonds, the central bank, is walking away from the table.
Exactly. Bond investors are looking at Japan's already immense public debt, which is over 250% of their GDP, by the way.
Which is staggering.
It is. And they are doing the math. If supply is going up and central bank demand is going down, the only way to attract private buyers is to offer significantly higher yields.
So investors aggressively dump their current bond holdings, driving prices down and yields up.
Right. Which brings us back to the most mind-bending statistic from the sources, the one you mentioned in the intro.
That a $280 million trade broke a $7 trillion market.
Yes.
Walk me through the exact mechanics of a liquidity vacuum. How does a trade that small cause yields to spike so violently across the entire Japanese sovereign debt curve?
It all comes down to the concept of the free float.
Okay, what's that?
Well, even though the total Japanese bond market is valued at $7 trillion, the Bank of Japan has spent the last decade executing a policy called yield curve control.
They were basically printing money and buying bonds relentlessly to keep interest rates near zero.
Right. And as a result of doing that for years, the BOJ now owns roughly 80% of the cheapest to deliver 10-year JGBs.
Let me pause you there. Cheapest to deliver. Let's translate that. Are we basically saying the central bank cornered the market on the specific bonds that traders use to settle futures contracts?
Essentially, yes. When a bond futures contract expires, the seller has to deliver actual physical bonds to the buyer. There's a basket of eligible bonds they can choose from, and naturally, they choose the ones that are the cheapest to acquire in the open market.
Makes sense.
But because the BOJ bought up 80% of those specific issues, they are sitting locked away in a central bank vault. They aren't trading on dealer screens. So the actual pool of bonds available for active trading, the free float, is incredibly shallow.
Ah, okay. So when a relatively small sell order of $280 million hits the market, what actually happens in the order book?
Well, the order book is just a list of bids, meaning buyers, and asks, meaning sellers. Normally, in a $7 trillion market, there are thousands of bids stacked up at various prices, ready to absorb selling pressure.
Right, lots of cushion.
But because the BOJ owns everything, the order book was hollowed out.
It was empty.
Exactly. So this $280 million sell order came in following a weak auction for 20-year bonds. It immediately chewed through the few bids that existed near the current price.
And when those bids were gone?
When those bids were gone, the market makers, the algorithms and dealers responsible for providing liquidity, saw the imbalance and they panicked.
They didn't want to catch the falling knife.
Exactly. The market makers widen their bid-ask spreads dramatically, or they simply pull their bids altogether. Suddenly, the seller is looking for a buyer, and the next available bid is vastly lower than the previous trade price.
So the price gaps down violently.
Right, which triggers stop-loss orders from other traders, which creates even more selling into an empty order book.
And that is a liquidity vacuum.
That's the vacuum. A tiny pebble of selling pressure starts an avalanche because the mountain has no structural integrity left.
Wow. Okay, so we've established the mechanisms of chaos in Asia. South Korea is suffering a retail-driven deleveraging cascade over AI valuations. Japan is experiencing a sovereign bond liquidity vacuum driven by a clash between fiscal stimulus and monetary tightening.
Right.
But for you, the listener sitting at home whose 401k is packed with S&P 500 index funds and U.S. tech giants, the obvious question is, why should I care? How do these regional fires cross the Pacific Ocean?
The primary transmission mechanism is the global architecture of capital flows. Japan is not an isolated, closed-loop economy.
Not at all.
For the last 20 years, it has served as the anchor of global interest rates. Because domestic Japanese interest rates were pegged at zero, Japanese institutional investors, their massive pension funds, life insurance companies, and mega banks could not generate sufficient returns domestically to meet their liabilities.
Right. If you are managing a pension fund for millions of Japanese retirees and a Japanese government bond pays 0%, you are mathematically guaranteed to fail. You have to take that capital elsewhere.
You have to. So they engaged in what is known as the yen carry trade on a truly colossal scale.
The carry trade.
Yes, and the mechanics are elegantly simple but structurally dangerous. A Japanese institution borrows money in yen at an interest rate of essentially 0%. They convert those yen into U.S. dollars in the foreign exchange market. Then they take those dollars and buy U.S. treasuries yielding, say, 4%.
And they just pocket the 4% spread.
Exactly, minus a tiny bit of currency hedging cost.
I want to use an analogy here and tell me if this tracks. Think of Japanese capital as a massive, vital reservoir of water.
Okay.
For 2 decades, a system of aqueducts has been quietly channeling that cheap Japanese water across the Pacific, continuously irrigating the U.S. bond market. That constant flow of foreign buying pressure has artificially inflated the price of U.S. debt, which keeps U.S. borrowing costs relatively low.
That analogy perfectly captures the dynamic. The U.S. has relied on that Japanese reservoir to absorb our massive deficit spending. Japanese institutions are currently the largest foreign holders of U.S. treasuries, sitting on over $1.2 trillion of American government debt.
1.2 trillion. But now, the Bank of Japan is raising rates. The yield on a 40-year Japanese bond just crossed 4%. The uncollateralized call rate is moving up. The mathematics that carry trade are completely imploding.
And the implosion happens on two fronts simultaneously. First, as Japanese domestic yields rise, the institutions no longer need to take on foreign exchange risk to get a return.
They can finally buy domestic bonds that yield a respectable amount.
Right. Second, as the BOJ hikes rates, the Japanese yen strengthens against the U.S. dollar. If the yen appreciates, the value of those U.S. dollar-denominated treasuries plummets when converted back into yen.
Oh, wow. So the institutions start taking massive losses on the currency exchange. So the aqueduct's reverse flow. If the dam suddenly opens and all that capital repatriates back to Turkey, the U.S. bond market is left in a sudden, severe drought.
Global financial authorities are terrified of this exact scenario. They refer to it as the export shock.
The export shock.
Yes. If Japanese life insurers and mega banks decide to repatriate their capital, they must liquidate their U.S. treasuries en masse. When you dump $1.2 trillion worth of bonds onto the market, the price of those bonds crashes.
And because bond yields move inversely to bond prices, U.S. Treasury yields will spike violently.
Right.
This is where it hits the listener directly in the wallet. The yield on the 10-year U.S. Treasury is the foundational benchmark for almost all consumer debt in America. So a central bank committee in Tokyo votes 7-1 to raise a highly technical overnight rate, and 3 months later, the 30-year fixed mortgage rate on a house in Ohio jumps by a full percentage point.
Corporate borrowing costs soar. Credit card interest rates go up.
It's all connected.
It is a synchronized, violent tightening of global financial conditions, entirely engineered by domestic Japanese policy normalization. The cost of capital goes up for everyone, everywhere.
Okay, that perfectly explains the bond market contagion. But what about the equity side? How does a 14% drop in SK Hynix in Seoul threaten companies like Microsoft, Alphabet, and Meta here in the U.S.?
Well, for that, we have to analyze the semiconductor and AI supply chain vulnerabilities.
Okay.
The severe pullbacks at SK Hynix, Samsung, and also Kioxia in Japan are not idiosyncratic, isolated business failures. They serve as the proverbial canary in the coal mine for global AI capital expenditure, or CapEx.
CapEx being the hundreds of billions of dollars that the U.S. tech giants are spending to build these sprawling AI data centers filled with NVIDIA GPUs and SK Hynix HBM memory.
Exactly. The Asian chip makers or infrastructure layer, the picks and shovels providers of the AI gold rush. When institutional investors aggressively dump the stock of the infrastructure providers, it signals a deep, growing anxiety over the sustainability of the entire spending cycle.
They're starting to doubt the gold is actually there.
Right. The market is beginning to forcefully question the return on investment, or ROI, of generative artificial intelligence.
The logic is pretty straightforward. I mean, if Microsoft and Alphabet are spending billions on chips, but they aren't seeing immediate massive revenue from their AI software tools to justify that spending, they will eventually be forced by their shareholders to cut their CapEx budgets.
And if the CapEx budgets get cut, the order books for SK Hynix and NVIDIA evaporate.
Oof.
Gone. And there is a secondary geopolitical layer of anxiety pressuring the Korean memory chip makers specifically, which is the rising threat of Chinese technological competition. The sell-off in the KOSPI wasn't just about AI ROI, it was also triggered by developments across the Yellow Sea.
Yeah, the sources specifically mention the successful listing of China's Changshan Memory Technologies, or CXMT, on the Shanghai Stock Exchange.
CXMT is a state-backed entity attempting to break the global oligopoly in memory chips held by companies like SK Hynix, Samsung, and Micron.
And a successful public listing gives them access to massive amounts of capital to scale their manufacturing operations.
Right.
There are also intelligence reports suggesting that Chinese state-owned enterprises are making alarming progress in developing their own deep ultraviolet, or DUV, lithography equipment.
Which is huge.
It is. This is the incredibly complex machinery required to print microscopic circuits onto silicon wafers. If China masters DUV technology, they bypass Western export controls completely.
If China can successfully manufacture both the advanced memory chips and the equipment required to produce them, they will inevitably utilize their massive state subsidies to flood the global market with cheaper alternatives.
Which commoditizes the market.
They will commoditize the memory market, heavily undercutting the profit margins and market dominance of the Korean giants. That dual threat slowing U.S. capex and rising Chinese competition is what actively spooked investors into liquidating their Korean tech holdings.
Before we declare the AI revolution completely dead, though, I want to bring in a fascinating piece of historical context from our source material that pushes back against this panic narrative.
Okay, let's hear it.
If we analyze previous massive technological revolutions over the last 2 centuries, like the build-out of the railroads, widespread electrification, the telecom boom of the early internet, the capital investment during the peak of those cycles typically reached about 5 to 7% of total U.S. GDP.
That historical baseline is crucial for perspective, really. Because right now, despite the relentless media hype and all the billions being spent by the hyperscalers, current AI investment is only hovering around 2.5% of U.S. GDP.
Right. So we are only at half the historical capacity of a true paradigm-shifting technological investment cycle.
Yeah.
This suggests that from a macroeconomic standpoint, the runway for AI infrastructure spending is still massive. This might not be the bursting of an AI bubble. It might simply be the market violently digesting the first course of a very long multi-year meal.
It is a highly compelling counterargument to the doom narrative, I agree. It posits that the current volatility is just a localized pricing adjustment, a shaking out of the weak leveraged hands, rather than an existential collapse of the technology's underlying economic potential.
Which brings us perfectly to the U.S. stock market and the recent results. We've explored the global setup and the transmission mechanisms. Now let's look at how the U.S. financial system is actually absorbing these shocks. And we have to start with the Federal Reserve because they just threw a massive wrench into the delicate gears of the market.
We definitely need to dissect the July Federal Open Market Committee, or FOMC, meeting.
Our sources indicate that the Fed, operating under Chair Kevin Warsh, which is a fascinating geopolitical detail for this 2026 scenario, by the way, decided to hold the benchmark policy rate steady at a target range of 3.50% to 3.75%.
They have maintained that specific restrictive level since December 2025. But the critical variable here isn't the decision to hold. It is the unprecedented internal fracture within the voting committee itself.
Yeah, the vote was 9-3. And those 3 dissenting votes are what caused the U.S. markets to absolutely fracture.
Beth M. Hammack, Neil Kashkari, and Lori K. Logan all formally dissented. And they didn't dissent because they believed the economy was weakening and wanted to cut rates. They dissented because they believed inflation was reaccelerating and they wanted to hike rates by another 25 basis points immediately.
You know, instead of comparing the Fed to a driver with sensitive brakes, I think a better analogy is navigating a massive, heavily loaded cargo ship through a narrow canal like the Ever Given in the Suez.
Okay, I can see that.
Right. Turning the wheel of monetary policy takes 6 to 9 months to actually show an effect in the real economy. Chair Warsh is at the helm looking at slowing employment data, saying, let's just keep the wheel straight and let the ship coast for a bit. But you have 3 highly influential officers on the bridge, Hammack, Kashkari, and Logan, staring at sticky inflation metrics, screaming to throw the engines into hard reverse.
And the broader financial markets, who are essentially cargo containers stacked precariously on the deck of this ship, experience incredible structural whiplash just from the threat of those engines being reversed.
The mere threat is enough.
Exactly. Heading into this July meeting, derivative markets had only priced in roughly a 30% probability of a rate hike.
Which is low. Usually, the Fed communicates its intentions so aggressively through speeches and press leaks that the market prices in a 60 or 70% probability weeks before the actual meeting.
Right, so to have 3 voting members officially demand a hike out of nowhere was a total macroeconomic shock.
Boom.
The immediate market reaction was a violent recalibration of risk. When you combine that unexpectedly hawkish internal dissent with escalating geopolitical tensions in the Middle East specifically, news breaking of a missile attack that shattered a brief ceasefire, lull institutional investors just rushed to de-risk their portfolios.
Just get out of the way.
Yeah. The Dow Jones Industrial Average tumbled over 800 points, shedding more than 2% of its value in a matter of hours. The Nasdaq 100, which is heavily weighted toward the AI tech giants, was pulled firmly down into correction territory, sitting a full 10% below its June highs.
And the broader S&P 500 pulled back 1.5%. And compounding this generalized anxiety is the observable behavior of the so-called smart money.
Always watch the smart money.
Right. The sources highlight a glaring detail regarding Warren Buffett's Berkshire Hathaway.
Berkshire Hathaway is currently hoarding a record $397 billion in cash and short-term treasuries.
$397 billion. When the world's most historically successful value investor is sitting on nearly $400 billion in liquid cash, rather than deploying it into the equity markets, it fuels intense, widespread speculation that his internal models are forecasting a severe systemic downturn.
He is aggressively keeping his powder dry, waiting for the capitulation event so he can buy assets at distressed prices.
But this is where the macroeconomic narrative collides violently with corporate reality, right? There is a massive, glaring disconnect in the data. The global markets are bleeding, the BOJ is tightening, the Fed is hawkishly divided, and Buffett is hoarding unprecedented cash. Yet, the actual underlying corporate earnings of U.S. companies are spectacular.
It is a wild juxtaposition.
I need you to help me reconcile this because it feels like cognitive dissonance. If we look at FactSet's Earnings Insight Report for the second quarter of 2026, the fundamental data is undeniably robust.
Extremely robust.
With 27% of the S&P 500 having officially reported their results, the blended year-over-year earnings per share, or EPS, growth rate is sitting at an astonishing 37.9%.
And if that 37.9% growth rate holds through the rest of the earnings season, it will mark the highest earnings growth rate reported by the index since the third quarter of 2021 when the economy was rebounding from pandemic lockdowns.
And it isn't just top-line revenue inflation either. Net profit margins for the S&P 500 have hit a record 15.7%.
Meaning they're keeping more of what they make.
Right. Companies aren't just making more money, they are operating more efficiently and profitably than almost ever before in history. And 86% of the companies reporting so far have actually beaten their EPS estimates. They are crushing the expectations modeled by Wall Street analysts.
It's incredible on paper.
So how is the market crashing when the companies themselves are printing record profits?
You have to look under the hood at the exact composition of those aggregate earnings. That massive 7.9% growth rate is not evenly distributed across the 500 companies.
It's skewed.
It is heavily, disproportionately skewed by big tech. The FactSet data specifically highlights Alphabet, which experienced massive valuation gain surprises that artificially boosted the aggregate index numbers.
So it's a deeply top-heavy market. The magnificent giants are pulling the mathematical average up, masking potential weakness and margin compression in the other 490 companies beneath the surface.
Exactly. And furthermore, JP Morgan Asset Management's mid-year outlook points out a fascinating and frankly concerning shift within the giants themselves.
What kind of shift?
The U.S. hyperscalers, the elite tier of companies like Alphabet, Amazon, Meta, Microsoft, and Oracle, they are no longer moving in unison. Their pairwise correlation has dropped significantly.
Break down pairwise correlation for us, meaning they aren't just trading as a single monolithic big tech block anymore?
Correct. For years, if Microsoft went up, Meta went up. They traded as a unified proxy for the digital economy. But now institutional investors are starting to rigorously differentiate between the winners and losers within the hyperscaler cohort itself.
They are being picky.
Very. They are rewarding the companies that are actually monetizing AI and punishing the ones that are just burning capital on research.
And the data shows that while semiconductor earnings, the hardware side, like NVIDIA, are soaring astronomically, the earnings growth of the hyperscalers themselves, the software side, is actually beginning to slow down slightly.
Right, the divergence.
That divergence is the root cause of the anxiety. If the hyperscalers' earnings slow down, their stock prices drop. If their stock prices drop, their boards of directors will force them to cut costs. And the first thing they will cut is the multi-billion-dollar purchase orders for more NVIDIA chips.
Which brings the entire narrative full circle back to SK Hynix in South Korea. It is a highly fragile, tightly coupled ecosystem.
Which leads us perfectly into the final section of our deep dive. What are the experts predicting comes next? And what are the key actionable takeaways for you, the listener, trying to manage your own capital? Because right now, processing these crosscurrents feels like trying to navigate a minefield without a map.
It really does.
Let's start with the rebound signals. It is not all doom and gloom in the institutional analysis.
No. If we look back at the epicenter in South Korea, KB Securities head of research, Kim Dong-won, has published a very distinct contrarian take.
Okay.
He views the massive KOSPI drop, not as a fundamental breakdown of the underlying technology or the company's business models, but as an excessive, sentiment-driven liquidity panic.
He is basically saying the market lost its mind and it's going to snap back.
Yes, he is explicitly predicting a V-shaped rebound for Korean memory chips.
A V-shaped rebound meaning the chart crashes straight down, hits a bottom, and bounces straight back up just as violently. What is the fundamental logic driving that aggressive call?
Valuation mechanics. He points out that after this historic crash, global semiconductor linchpins like Samsung and SK Hynix are trading at incredibly attractive forward price to earnings, or PE, ratios of below 4.
A forward PE of 4.
I know.
That is insanely cheap for companies that effectively dominate the global technology supply chain. I mean, to put that in perspective for the listener, the forward 12-month PE ratio for the broad U.S. S&P 500 right now is hovering around 20.1. So the Korean chip makers are trading at an 80% discount compared to the broader U.S. market, despite holding monopolies on critical hardware.
And Kim's core thesis is that the U.S. hyperscalers believe that a lack of AI investment is a far greater existential risk to their corporate survival than overinvestment.
Right, FOMO at a corporate level.
Basically, if Meta stops buying chips and Microsoft builds a better AI, Meta ceases to exist in a decade. These companies have the fortress balance sheets to continue spending tens of billions on AI infrastructure for years, even if they have to increase external borrowing to finance it.
The AI arms race is too critical for them to pause just because retail investors in Korea blew up their margin accounts.
Exactly.
We also have Nomura weighing in, and their outlook aligns with this idea of an eventual recovery, though their analysis focuses much more heavily on market mechanics than just valuation.
Nomura characterizes the current pain as a forced deleveraging phase. This ties directly back to our earlier discussion about the 2x leveraged ETFs and the margin call cascade.
Right.
The selling is feeding on itself mechanically, not fundamentally. But, Nomura argues, once that technical, forced selling by foreign investors and retail margin traders finally exhausts itself, the underlying corporate fundamentals will reassert control over the price action.
And what mechanism is going to actively drive the price back up? Because a lack of selling doesn't automatically mean prices rise, You need active buying.
Nomura points to corporate share buybacks. They anticipate that large-cap Korean companies, seeing their stock trading at a PE of 4, will step into the open market, buy their own artificially depressed stock, and cancel those treasury shares.
Oh, that makes sense.
This fundamentally reduces the supply of available shares on the market, which mathematically pushes the price of the remaining shares higher, assuming demand remains constant. They actually project the KOSPI eventually re-rating and pushing toward a 10,000 to 11,000 target once the liquidity dust settles.
Wait, hold on. Let me push back on Nomura's premise here for a second. We just spent 20 minutes discussing how the Bank of Japan is raising rates, which is ending the yen carry trade, which is causing the cost of capital to spike globally.
Yep.
If interest rates and borrowing costs are going up everywhere, where are these Korean tech companies getting the cheap cash to fund massive share buyback programs? Doesn't the idea of a debt-fueled buyback spree directly contradict the whole end of free money macro thesis?
That is a phenomenal critique, honestly, and it highlights the tension between macroeconomic theory and microeconomic reality. You are entirely correct that external debt is becoming drastically more expensive.
Right.
However, Nomura's thesis relies on the internal cash flows of these specific companies. SK Hynix just reported a 600% earnings jump. They aren't borrowing money from Japanese banks to buy back their stock. They are using the massive piles of free cash flow generated by selling HBM chips at premium margins to NVIDIA.
Ah, okay.
They are deploying their own operational profits to shrink their equity float.
Okay, that makes sense. The macro environment is tightening, but the micro balance sheets of the winners are still flush with cash. So that's the view from Asia. A painful deleveraging followed by a cash flow-driven recovery. Let's look at the U.S. institutional outlooks, which offer a really fascinating juxtaposition between short-term tactical trading and long-term macro strategy.
Yeah, JP Morgan's Tactical Positioning Monitor provides a highly compelling short-term view. They recently flashed a tactical buy signal, formally classifying the U.S. equity market as oversold.
So they're telling their high net worth and institutional clients the panic has peaked, this dip is a buying opportunity. What are the specific tailwinds they are citing to justify catching this falling knife?
They cite 5 highly specific mechanical drivers. First, Bond yields have started to retrace slightly after the initial BOJ-induced panic spike, relieving some pressure on equity valuations.
Okay.
Second, the U.S. dollar has weakened, which mathematically boosts the repatriated profits of U.S. multinational corporations.
Good for tech.
Very. Third, as we discussed with the FactSet data, the underlying corporate earnings remain historically strong. Fourth, their geopolitical models suggest that tensions in the Middle East might be showing preliminary signs of stabilization.
Okay, that's 4.
And fifth, despite the hawkish dissenters screaming for a hike, Chair Warsh and the Fed majority did ultimately hold rates steady, providing a baseline of policy stability.
So tactically, in the short term, JP Morgan says buy the dip. The mechanics support a bounce. But if we zoom out and look at the long-term, multi-year macro view from institutions like Vanguard and JP Morgan Asset Management's broader strategy team, the tone shifts dramatically from buy the dip to brace for impact.
The macro analysts are tasked with looking at structural, systemic risks that short-term tactical traders often ignore or just model out. For instance, JP Morgan's mid-year outlook extensively models the severe geopolitical risks emanating from the Middle East. If the current skirmishes escalate, and the Strait of Hormuz, which is a critical choke point for global energy supplies, were to face prolonged military closures, their models project a scenario where global oil prices could spike above $150 a barrel.
Wow. And if crude oil hits $150 a barrel, that acts as a massive, immediate, regressive tax on every single consumer and business on the planet.
Instant tax.
It costs more to manufacture goods, it costs more to ship goods, and it costs consumers more to drive to the store to buy the goods. It would reignite inflation instantly, which would force central banks like the Fed to actually hike rates aggressively into an economic slowdown.
Which completely destroys the soft landing narrative.
Completely.
It would engineer a classic stagflationary environment. Recessionary low growth combined with structurally high inflation. Stagflation is the absolute worst-case scenario for institutional portfolios because it destroys the value of both equities and bonds simultaneously. There is nowhere to hide.
But Vanguard and JPM Asset Management aren't entirely bearish, right? They aren't telling clients to liquidate everything and buy gold bars in the woods. They still model a path forward for growth over the remainder of the decade.
No, they remain fundamentally constructive on risk assets in their baseline scenario. Their overarching view is that despite the complex, shifting geopolitical backdrop, the global economy still possesses massive structural growth drivers.
Like what?
Well, they forecast that the relentless push for AI capex, combined with a generational wave of government spending on national security infrastructure and supply chain onshoring, which is driven by global political fragmentation, will eventually re-engage the economic engine strongly as we move into 2027.
So how should a normal listener process this? We have South Korea liquidating on margin calls, Japan breaking its own bond market, U.S. tech earnings looking spectacular but top-heavy tactical traders saying buy, and macro analysts warning of $150 oil. How do you actually manage a portfolio through this transition?
It requires a strategic psychological pivot in how you view market structure. First, you must look past the immediate, visceral panic of the daily headlines.
Turn off the TV.
Exactly. The market is currently experiencing a return to historical norms of volatility after a long, artificially induced period of eerie calm. You have to mentally prepare yourself to expect 800-point intraday swings in the Dow to become somewhat regular occurrences during this regime shift.
Meaning, do not let an algorithmic margin call-in soul panic you into selling your retirement assets at the bottom?
Exactly. Second, you have to deeply internalize that the fundamental rules of the global financial game are changing. The 2-decade era of seamless globalization and 0% interest rates is definitively over.
Done.
We are entering a new, structurally tighter regime characterized by stickier inflation, shifting central bank policies as evidenced by the BOJ finally moving off zero, and the violent unwinding of massive global capital flows like the yen carry trade.
So if the free money era is dead and buried, what actually matters for investors going forward?
Tangible, unmanipulated fundamentals, underlying free cash flow, sustainable profit margins, and the actual demonstrable adoption of new technology. The corporations that survive and compound wealth over the next decade will not be the ones with the most aggressive hype cycles or the most leveraged ETF exposure.
Right.
They will be the companies with fortress balance sheets, unassailable pricing power, and the proven ability to demonstrate actual return on their massive AI investments.
Which perfectly sets up the final thought I want to leave you with today. We started by examining how the interconnected plumbing of the global financial system is being tested. We saw how the Bank of Japan raising a single overnight interest rate by a fraction of a percent can theoretically break a $7 trillion bond market, reverse the flow of global capital, and ultimately raise the cost of a mortgage in Ohio.
It's all connected.
It is, and we saw how the equity market violently punished SK Hynix, despite printing historically incredible earnings, simply because they failed to meet a newly established standard of absolute exponential perfection. So, here's the question you need to wrestle with as you evaluate your own financial positioning. If the fundamental macroeconomic premise of artificial intelligence infrastructure spending is actually sound, if this truly is the dawn of the next great industrial revolution, but the market is structurally poised to severely punish any company that fails to deliver immediate, flawless profitability. Are we actually witnessing the premature bursting of the AI bubble? Or are we simply witnessing the necessary painful end of the free money phase? Are we finally entering the mature era of this cycle where the AI companies, after years of unlimited hype and massive zero-interest capital raises, are finally being asked by a sober market to generate real cash flow and pay the rent?
That is the defining macroeconomic question for the next decade of capital allocation. The underlying technology appears remarkably real, but the cost of the capital required to build it is no longer zero.
And navigating that transition is going to require a lot more rigor than just blindly buying the dip on a flashy tech ticker. Thank you so much for joining us and diving deep into the mechanics of the market with us today. We will see you next time as we continue to unpack the unseen forces shaping your financial future.